Let's talk about earnings, because that as well is something that is moving the needle perhaps for markets, or at least for individual stocks. Bajaj Electricals has come out with its first quarter numbers. Margins are flat and the first quarter profit has shrunk. Though on the revenue front, it's interesting to note that the consumer durable business has managed to show an uptick of more than 30%. So let's understand what went by in the quarter with Anuj Poddar, Executive Director. Anuj, thank you for joining in on ET Now. A quick glance at your numbers, and while you've done well on the top line, it's really not reflected in your margins, and there's this sharp downtick in the profit after tax. It's just 13 crores. So is there any one-off or anything that has hit the bottom line despite the good top line performance?
So let me break that up for you. Firstly, I think I'm very pleased with our results. I think in this environment of gloom and doom, our consumer products business has done exceedingly well, far ahead of industry. We've grown our consumer products top line at about 31.7%, and our consumer EBIT has grown by over 21%. To your question on the bottom line not reflecting that, that's a function of the consolidated bottom line. The big cost that has come in there is the interest cost. That's a function of the debt for the EPC business. I think important here to talk about is strategically we've taken a call that our mix of consumer and the EPC business, from here on we are going to drive much more aggressively on consumer growth like you're seeing this quarter, and the EPC business is something that we're driving on a far more calibrated basis, which is why the EPC business on a year-on-year basis is flat. There is a high cost absorption on the EPC business, but all the interest that you see is really linked to the EPC business and the debt on the balance sheet. If I were to just forward look out into the future on that, we are in the process of fixing the balance sheet and bringing our debt levels down, which to my mind will see the interest to start taper out a few quarters down. So the underlying story remains a strong growth in consumer business, far ahead of market and industry, and that is something we're very focused on, and that is something that we believe will continue to create value for us.
Debt down. If you bring your debt down, would you be selling assets, or would you be looking at reducing some of your non-core businesses, low margin businesses, and once you start reducing your exposure there, you will be able to return capital back to the banks?
Right. So I don't think we're looking at selling any assets. The way I see that playing out is we are taking a conscious call that this year and next year we are going to be very laser focused on cash flows. It will be a positive cash flow business for us, and far more aggressively focused on ROCE. What that means is with the consumer business delivering a higher ROCE for us, that's where the growth will come from. The EPC business, we are starting to become a lot more selected and a lot more conscious of the bidding that we do, with the intent to actually do that in a far more contained manner, which should throw up cash and bring back some capital from that business. Therefore, I will see an unwinding of that business where I will be able to pull back some of the capital employed in the EPC business, which will come back in and be used to repay some of the debt that we have. So the next 12 to 24 months, you will see cash being thrown up by both our consumer and the EPC business, and that will help to actually bring down the debt levels and bring down the interest cost for us.
Okay. What has supported the strong growth in the consumer durable segment, Anuj? What would you attribute this to? Is it seasonal? Is it a delayed monsoon? Is it inventory-led? I mean, also given that festive season is around the corner, what are you also expecting going ahead on this segment?
I think a couple of points. One is, we've been, had rejigged our whole distribution network about 3 to 4 years ago. We are now 5 quarters into the benefits of that distribution rejig. We are today distributed across more than 2 lakh retail outlets. We are probably the most deeply and widely penetrated consumer company in our sector. So we are seeing now the uptick on sales on the consumer front due to our penetration. But more importantly, we are focusing very strongly on product development. We've done an advertising marketing push this summer for our coolers and fans, both of which have delivered extremely handsomely on growth, and we've seen growth across our product categories. And like I said, this comes from multiple steps where our focus really is on driving consumer business going forward ahead of market and increasing our market shares in the consumer products business here. The season, to my mind, it was a late start to summer, but that really affected Q4. This Q1, you had the full play out of summer, and therefore it's done well.
Okay, so that's your top line, and yeah, I mean 30% plus consumer durables growth. On the bottom line, you explained interest. So what went wrong in the margins then? Because that's just where it was even in the corresponding quarter at 5 odd percent, so 5.5 odd percent. So what's going wrong with the margins then?
So actually, again, it's important for people to start looking at a business segmentally. Let me first talk about the consumer segment. Our consumer segment margin was 7% last year. It is 6.5% this year. But in absolute terms, it has grown by 21%. I'm talking about EBIT. The 6.5% marginal decline in the margin is really a function of product mix. Our coolers and fans have been the growth drivers for us this summer. Coolers actually grew over 100% for us this summer. Fans grew by over 40%. Both of these product categories are lower margin contributors. So the aggregate drop in percentage margin is a function of the product mix. I would not worry about that. The total margins that you see a decline is really coming from the EPC side of the business. But like I said, that's a strategic call that we've taken on the EPC business, that we are happy to actually let that business start becoming far more selective going forward. Till that happens over the next 3 to 4 quarters, you will see a certain lag effect of the higher cost structures for the EPC business, but that will take care of itself over the next 3 to 4 quarters. So really, it's a story of two businesses, two segments. The consumer business continues to do very well, the margins and top line, and the EPC business will correct itself over the next 3 to 4 quarters.
Anuj, thanks for joining us this afternoon and sharing with us the latest there with regards to earnings and the outlook going forward. Good chatting with you.